and then stream. I don't know where the streaming option is again.
Try share.
I think that's just for the screen. I don't see anything else in it. 1 second.
You tried record?
Yeah, I hit record, but that doesn't go straight to streaming. Let me see.
Oh, okay. I'm on my phone, so it won't let me see everything.
All right, I'll find it.
So so the paid part of it is for the stream and for this part?
Yeah,
Okay.
yeah. So what we plan to do, and then after a stream, with it being recorded, if they want to get access back to it, they could go back to the videos and access it as well too. Um, I'm trying to find where it is. I have okay, streaming, Zoom, account management, account meeting, media bots. Um, I have a recorder. I could just upload it later if anything. Sounds good.
Sounds good.
Oh, I don't do that. Slideshow. All right, hello everybody. Welcome to officially our fourth out of the fifth series of our funding workshop for startups. This week, which is the fourth week, is to go from zero to financial statements. So the main goal of this workshop is for the last couple of weeks we would have talked about the fundamentals in terms of one, using the business model canvas to get a good lay of the land of your business first and foremost. But in this particular workshop, we're going to focus on two of the main areas within that canvas, which is revenue streams and costs breakdown. That leads to the elemental components that you will need to plug into financial statements. And these documents, what we call the financial statements, are very important in relation to those individuals seriously trying to find funding, whether that might be through private equity, through grants opportunities, or even going directly to the bank. Um, Startups have a love and hate relationship, especially early startups at this stage, because they're so focused on just operating, making revenue, and just making sure I run the business. But at some point within the journey, you definitely have to come back to your financial statements, if not only from an operational perspective, but also when you do have that conversation about growth and taking on potential investment. These documents, although might be scary at first, are very helpful for your growth and your journey. So I'll be talking about some of the components in this workshop, and I'm also joined by our guest speaker tonight, which is Davinia Bain.
Hi.
Hey everybody. I haven't prepared a official bio for you, Davinia, but
Not needed.
even from her time at UB to the Small Business Development Center, where she founded, even to our new ventures right now that include Crypto Isle as well too. So she has a range of experience, not only working with these financial statements on a professional level and helping others with their financial statements as well too. She is in the trenches, and she could talk a little bit more about certain things that she possibly focus on and the strategies that come with that as well too. So thank you all for joining us. Just to do a quick overview again, the main things that we want you guys to walk away with is understanding the key financial documents that we'll touch on in this presentation. Learn how to present financial statements, especially when it comes to focusing on particular points where there might be a pitch or even in a memo that you might have to give to potential investors. And then also, it would be your opportunity to ask questions and get advice on organizing and maintaining your financial records as well too. Because the key thing that we also want to highlight as well too is that different natures, the different businesses have different natures, which means they might focus on certain things more or less given in a financial statement as well too. But we hope that we walk away with more confidence about the financial documents, knowledge of the numbers and why they matter, and build your own robust checklist of things that you need to look at from a financial perspective as well too, right? So what we talked about before is um, using our primary tool, which is the business model canvas, which are these 9 kind of segments that businesses should focus on, or a high level view of what you will talk about within your business proposal or your business plan. Today, we are focused on these 2 main areas, which by now you should have plugged in a lot of what makes your businesses unique in these regards to see what are the levers of the costs and the expenses that your businesses currently have. But then also tying that to the revenue streams and how your business makes money, or the pricing model in which the business makes those makes revenue come into the business. Right here was just an example of this is a good representation of the cycle in which you go through on a day-to-day basis. You might not have something as robust as thinking about accounts receivable and accounts payable as in departments, maybe not yet. But for right now, think of accounts receivable simply as the money coming in, and then the accounts payable as the money going out, which would be your expenses. On any given day within a business, this cycle of operations happen between the working capital and cash flow, where you sell a product or a service, you have cash coming in, but then you also have to pay for tools and other expenses, which is cash going out. And all of these already have their own categories and names in terms of sales, the cost of sales, which might translate into marketing activities, or the cost of acquiring particular customers, and then your expenses, which are your day-to-day operating expenses. It might be fixed expenses, it might be variable expenses. And then when you minus that from what you bring in, you have the profit of what the business needs to get. This is a very simple cycle of a common activity that happens in most businesses, right? When we get into the woods, especially from an accounting and a finance perspective, one thing that helped me when I tried to break down and try to get a hold on all of the moving pieces of the business is a term that fortunately accountants use as their baseline in order to track all the different categories of all the things that we talk about in an average business that goes on. And they call it they put these categories in what they call a chart of accounts. Why is this important now? And I know this graph can look a little bit scary, but just think of right now your chart of accounts being the labels of the category for either all of the cash coming in the business, and then the cash coming out of the business, that allow accountants to, when they help prepare statements, to see the different categories and the components for that outline the main data and the main points that will be important not only to the accountant but to the individuals who are reviewing the financial statements as well too. So for right now, just think of this as buckets and categories for each of the moving pieces of your business, where there might be cash coming in or cash coming out. Any thoughts or questions at this particular point, Davinia or Shanna, that you wanted to hop in on?
No.
Okay, cool. Which brings us to our financial projections, the key metrics going into why it's important. So whether you have experience or had the opportunity to work with any of these companies, local or international, whether it might be through a traditional bank or a bank geared towards startup development and funding, a part of when they do a call to action for a grant or a loan opportunity, underlying requirement that they ask for, what they would like for from startup businesses, is they want to see data, i.e. your financials of the business and how it's been run since you've been in operation. Again, for most of the opportunities for startups that we work with as well too, it might just be an idea with no operations at a particular stage, and they're just looking to at least incubate their initial idea and get to a good place where it's refined enough for when that next step, for when they go to ask for funding, they'll be prepared, or at least in a better place, in order to talk about financial statements and projections. At that stage, for most startups who don't have a long track record, a lot of this is a lot of the data in terms of like what you project to bring in, and then your costs and expenses are through trial and error of you assessing and developing your business at the time. So like you might have a starting point of, okay, this is a product or service that I am providing, and I provide the service at X amount of dollars, either per hour, or it might be a fixed cost or a fixed rate. once you have that idea of how much your product or service will cost, you could start to extrapolate numbers from there in terms of how much money you project to make on a weekly basis, a monthly basis, a quarterly basis. That gives you a starting point of what you think your projections are for your financial statements. That should also be coupled with the more tangible, if you are currently in operations, what are the things that you're spending money on? Are you spending money on rent? Are you spending money on technology and equipment? What are the things that are costing you money on a weekly, monthly, quarterly basis that you could put side to side with your revenue to see how much money you're coming in and what's going out? That's usually the starting point for a lot of early startups. For those startups that are fortunate enough to be operating for a few years, more than likely they should have been tracking their financial statements, whether they are using a free online tool, or free or paid tools such as Wave Accounting or QuickBooks that we'll talk a little bit more down the line, where they are plugging in their numbers and their information as they go on a monthly basis of the money that they're coming in through their invoicing and expenses for the receipts that they have on a day-to-day basis. Those are very important data points to start accumulating over time, because you need to put that and formulate that, which will be in the financial statements that you then present to entities like this, so they could see and make a good judgment on the health of your business and if you're viable enough to get funding or financing for the business as well too. The three main statements that we'll talk about primarily that'll be of interest to most startups is your balance sheet, your income statement, or another version of saying what an income statement is, your profit and loss statement, and then a cash flow statement. One of the three, the why are these important? It just gives you a standardized view. If you're doing competitive analysis as well too, that you should be if you have a lot of competitors in the space, it allow you to extrapolate how your company is doing compared to other companies, or how they should performing, depending on if that information and data is readily available. Sometimes it isn't, and it's hard to get a hold on to, but you could still, when you have your expenses kind of logged, is a good starting point to see what are the similar components or the categories in your business and how it's tracked in other businesses, or how it should look in other businesses. It tracks your own personal performance, and then obviously from a financial perspective, it determines your loan legibility. So in the sense that your business is healthy, which means you're making more money than you're spending, it gives you a better opportunity to get a loan versus the reverse of that. Two main things to keep in mind in terms of the main ideas that you walk away from a balance sheet and an income statement. A balance sheet, when generated, is a snapshot view of a company at its current point in time. So when you generate a balance sheet, given all your current assets, your liabilities, and what your equity is, whenever that's generated, it gives you a snapshot of where the company is at that current point in time. An income statement is more like a film where you could generate a statement over a range of time, whether that might be for a quarterly period, a monthly period, or usually an annual period, that allows investors to see what your performance is in your business financially is on a year-to-year basis. And then your cash flow statement is essentially ad hoc, where at any point in time when you generate a cash flow statement, it gives an idea of how liquid you are and how much cash flow you have at any current moment in the business as well too. Does that make sense to anybody so far? Does anybody want to hop in at certain points? Good? All right. So again, when we go to examples of a statement, what we see is a bunch of numbers separated by single or double lines. They're usually indented at certain points to show which categories go into what categories. When you look at it at any of these type of statements at first, it could look scary. And we're wondering, why does this make sense, or why this is needed? What I present here is for seasoned professionals in finance, whether that might be the individuals responsible for your loan or providing you funding. These are the questions that the primary questions that they're asking for each type of statement when they look at your statement, or this is how they're assessing and evaluating the statement at a snapshot. As a startup, it's something that we have to continue to refine and make practice of in terms of learning how the numbers make sense to what, especially when we go to and talk about ratios and really assessing financial statements. But these questions here are essentially what are the main questions that their individual who is assessing your financial statements are asking. So when you look at it from a balance sheet perspective, they're asking how much cash or liquid assets are available at any point in time. Are there any intangible assets? If you are a company that is a big brand, what is the goodwill value of that business? And certain profit statements as well too. On any given operating cycle is like if you are a business that have inventory, how much inventory do you have? What's the value of that? How long has that been on hold, and how fast does it move through the system? All of these are examples of what individuals could see when they really look in depth at your balance sheet. From your income statement, how high or how low are your margins are depending on what it costs for you to actually produce the product or service. And is there room to increase those margins? How stable and predictable is the business? Is it a business that will continue to generate money on a consistent basis every given day or week? Or is it a seasonal business where you might only really pop off during Christmas? If that's the case, how healthy really is your business if it's only a seasonal business? Stuff like that are what you try to get from an income statement. And then a cash flow statement, primarily what we talked about before, is just how is your cash flow positive or negative? Are you in the red? Are you in the black on a day-to-day given your operations? That's just a high-level view. I don't know if you want to hop in on any particular point on that, Davinia.
I don't want to interrupt your flow. There are definitely different things that different types of investors look for. And then some of this, you always think about, well, who is it really designed for? Sometimes you really just need it for yourself. Like, what do I look at it for when I want to know if I'm going to survive this month or not?
Right.
Those types of things. So it's really, the vantage point, who's asking the questions. That's who prioritizes what questions to be asked. But
Mm.
I'm sure we'll get into some of that when we dig into the Q&A.
Yeah, awesome. Thank you.
Yeah.
Okay. But yeah, so this is just more of a breakdown of it shows the main, these next few slides will show the main uh areas or the main categories that are included within a balance sheet. Although this isn't an extensive list, again, the nature of the business might be more or less, or the certain names might be switched around depending on the nature of the business. But for the most part, these are the main components or main category blocks that you'll find within each of the particular sheets. So in a balance sheet, your main areas of focus are your assets for the business, and then your liabilities, and then a part of the liabilities is your share of equity. I believe it isn't here, but the formula, what they call the accounting formula, is your assets should be your liabilities plus equity, correct, or equal your liability plus equity.
Yes.
Yeah, so I'm trying to go back to my accounting classes as well to trying to go through this, but basically within the asset components of your balance sheet, um, what are your current assets that you might use or consume within a period of time, or like let's say given a year, in terms of what's your cash on hand, what's your accounts receivable, if you have the physical inventory, and then other current assets. And then the difference between the current assets and the long-term assets are, if I'm not mistaken, are the things that you have on the books but might not necessarily be consumed within a given year or a period. So a long-term asset might be your uh,
Could be a building,
yeah,
could be any asset that depreciates more than a year or depletes over a year.
right. So your lease agreement or whatever it is,
Well, no, the
oh,
lease agreement is a little different, but maybe a leasehold improvements
right.
that might be long term. But most people see long term assets as fixed and tangible. You may have some, uh, yeah, like equipment, for example. For the most part, if it doesn't depreciate 100% in less than a year, then that's a long term asset.
Mm,
Buildings, etc., that sort of stuff.
right. Thank you. And then on the next side, you have the liabilities, which is, the current debt that you might hold. And then longer term would be like longer term debt that goes in that as well too. Your payables, in terms of what you need to pay out for your current expenses. And then the shareholder equity for those businesses that are to the point where like you are a limited company, where you would have what the current stock split is in terms of the value of the stock, how much stock is still available within the company for people to possibly buy, and all that stuff like that from a shareholder equity perspective. And then and then I think it also reflects, what the current value that the shareholders would have put in over the period of time for the business as well too. That are
If you don't mind, Travis, I should have stopped you a few seconds ago. If I could just speak on the payables for a second.
Yeah, go ahead.
So this is a technical point, but it's very important again for any small business person reading their own financials. It's important to know the difference between the cash method and the accrual method. So, like right now, with when you go to file VAT, if you're taxable, if you have registered to file VAT, you don't want to produce those figures for inland revenue on the cash method. You want to produce those figures on the accrual method. And that's why knowing your payables is important. So, for example, if every single bill you get, you pay it with cash, and you run your business pretty much on the cash method. If every time you sell something, somebody gives you tangible cash, no, okay, you pay me on terms, you pay me in 7 days, 30 days, no terms, 100%, they give you the money right away, then you're basically running your business on cash. For most people, that's not the way it happens. Most people, a lot of businesses, they have something called accounts receivable, where they take their time to receive the cash, but they book the sales. Likewise, with payables, you may take the time to give the cash, but you book the expense at the minute that you consummate the exchange of value. So it's important when you look at your payables, if payables may be high and you may not have the cash to necessarily pay those, but just because you're not paying your bills doesn't mean that your expenses aren't going up. Likewise, your clients may not be giving you the cash right away, but your revenue, you may see your sales going up, but you don't get no cash.
Your cash flow on hand.
Exactly. So you find, this is why I made the statement I made earlier, that from an investor point of view, a lot of times the first of these three sheets they go to isn't the P&L or the balance sheet, but it's the cash flow, because they want to know, well, what are we doing? If we're not in business to produce cash, then what are we doing really? So the first thing they want to know is, are you a cash cow? Are you a cash guzzler? Is it going to take forever for you to convert assets into liquid cash, that sort of thing?
Right. Right, which is important. And I have an example there of the cash flow statement. I put it after these two because they kind of flow into each. But to your point, again, which is valid, what is the appetite of your investor, the nature of the business? It all equates to what questions that they're going to be asking and what they need to focus on looking for primarily. This is, and we would have touched on this in the a few of the sessions before, is that yes, raising money is important, but from who you take money from and what their terms are is also important as well too. And you have to find that alignment between the money that you're asking for. Hopefully it comes with mentorship, which will always be ideal. But then how is that money, what is the expectations of that money being applied to your business? What's the time that you need to pay back, and what do they really care about? So all those things come in important of that as well too. Just to go back for a second, so like the main components of an income statement or a P&L statement would be your revenue, your gross profit, which is your revenue minus cost of goods sold, your gross profit minus operating expenses, your operating income, your pre-tax income if you're calculating your taxes within that as well too, if you are VAT compliant, and then you get your net income, and then from a limited perspective, or from a limited company perspective, You'll also be able to see what the earnings per share is given the shares that you might have distributed in the company at any point in time. And then just to hop to the cash flow statement, just like what Davinia said, probably a primary document that they look at first. You could think about it being divided in three main areas, which is what is your cash flow from an operating activities perspective? So like what are your operating expenses on a day-to-day, weekly, monthly, yearly basis? Your investing activities, which is if you are borrowing funds, or like if you have investment in your company, what are those investments going to as well? So a term that you might hear floated around for a lot of companies too is talk about how much is in your capex, which is short for capital expenditure. Like what money is going where into your investments that isn't a part of your everyday cash flow, but it still is value and going somewhere within your business. That's within the investing activities. And then it's the financing activities as well too, where like if you are taking money, especially primarily from a loan perspective, what is the borrow and repay debt of that loan? If you are issuing or repurchasing stock, depending on if you're a big enough company or if you're a type of business that puts out stock like that, especially if you exchange for investment. What is the terms that what are the costs and the terms that revolve around that? And hopefully the thing that everybody wants to go to is eventually paying out dividends for the investments. How much do those dividends cost and what is that on a given basis? Um, the cash flow statements, again, the three main statements that we talked about, they have parts and components that blend into each other. So the bottom line of the income statement, your P&L, which is your net income, is connected to the retained earnings section of the balance sheet. And similar with the cash flow statement, where whatever your ending cash balance is, it goes to the top of your balance sheet under assets. And depending on the nature of the business, these categories might expand or be reduced at any point. Davinia, I don't know if you wanted to say anything before I moved on. No, just not.
No, that's good.
Yeah, yeah. So from here, I want to talk about tools. So primarily what we talked about initially is from these components, what you should be doing at this stage is breaking down all of your costs and your potential costs. Even if it just starts as a list, then immediately from developing that list for your costs and your revenue, you should be able to start putting them in categories that reflect a chart of accounts. So when we move to this next particular component, when we talk about tools, because nobody expects you. I mean, if you are a boss, you definitely could do it. You might be a master at spreadsheets and Excel, where you build your own statements from scratch. But if you're the average everyday person and you don't know how to design those documents line by line, there are great tools out there and accounting tools like Wave Accounting, which we use as well too, but similarly QuickBooks that allows you to input the information for your company as it comes in, the transactions, and then tracking the invoices. And then usually these tools generate these documents for you after you put in the information. And the more correct or accurately you could input that information, depending on the categories of the chart of accounts, you should be able to get a robust income statement or a P&L statement that could be generated through these systems. So if you are a startup and you are not using an accounting tool right now, I urge you to do that probably sooner rather than later, even just to capture the information from a historical perspective, but then also get comfortable enough to use these tools where when you sit with your accountant, if you're not the accountant of the company, you'll be able to go line by line and see what numbers make sense, to see where you can improve on your business when you generate these documents and assess these financial statements, and then move from there. This will get us once you spend enough time with your business and your financial statements, you eventually get to the point where you could look at the numbers that are generated from each of the businesses and really hone in on your key performance indicators or KPIs. Again, your KPIs. Yeah, go ahead,
So
Divya.
I hope I'm not messing up your whole workshop, but you said something earlier that I really don't want to gloss over. You talked about how one identifies their costs and their revenue streams.
Right.
So there's a little trick that I like to tell people to do because it works for me every time. Um, your first tool that you should create yourself is you got to sit down and literally map out, well, how do I make $1? What are the things that I have to do to make, let's say you're selling hats, like literally map out the entire process. Um, People often say, okay, I don't know accounting, I don't know this, but you should know at least your business or what it is that you're selling. And if you write it out, whether it's a cyclical form, flows, or just literally a list, or talk it out to ChatGPT and say, literally, this is what I do to make each product, to produce each service, to get through a day. And when you say it out loud, then you're able to say, okay, what does it cost? What does each node in this process cost me? And you break down those units. But visually, you're able to really see the map and appreciate all of the things that you forget about that actually cost you, like electricity, like favors from other people that you only have access to because of your network, which is an asset that we often forget. So I would say, your first chart on top of all of these charts is a flow of what it is that you do to make money. The chart of the account is the most daunting part of accounting. I mean, most chart of accounts is thousands, based on how big the business is. You could really have hundreds or thousands of accounts. And so, I would be very surprised if there's any uh, budding entrepreneur who could really grasp that at once. But you could grasp what it is that you do, why you do it, and how much each of those pieces cost. That's my 5 cents.
Awesome. Yeah, thank you. Um, but yeah, again, to the point of this, I felt I wanted to. I was on the fence of including this graphic, especially after talking about everything that we talked about to make it more complex again. But the main idea I want you to get from this is, again, when you spend enough time with these documents and you go through them and really try to understand them, you over time will be able to focus on which pieces go where. You'll start to see the flow of how these relationships go from document to document. We haven't mastered it yet. It's still it takes something that takes practice and years to develop. But once you get to it, it's almost like that is a level of mastery in terms of you'll be able to see what the main components and pieces of each document is and where it comes from and how it relates to each other's, which essentially is the same thing that we hope that you get from the business model canvas as well too. Over time, that if you continue to develop your business model, you should be able to see what pieces are related to what and how the levers move, right? To the point in which now you could take it a step further and look at talking about KPIs, different ratios and rates that allow you to um, communicate your company better in terms of the performance of your company, where it really matters, and even on a level where it might be annually or quarterly. Once you're more comfortable with your numbers, you could put them in formulae that allow you to be like, okay, when an investor asks you, okay, so currently what's the burn rate of your company? You don't have to like, what is a burn? Like, I don't know what that word means or what that is. Essentially, it means what is the run, how much money is your company burning on a monthly basis. Once you get comfortable with your numbers, you'll be able to understand what they care about, but then also you'll have your mental dashboard, if you don't build a physical dashboard, of how these numbers play in different parts of your company, which makes you not only a strong business, but when you talk about investment and you know these numbers and you're able to communicate these numbers, it makes your investor more confident in taking the chance to fund you as well too, because you know all the moving pieces of your business. So it only really benefits you by understanding the kind of the individual components once you learn them over a period of time. One website that we like to go to for reference as well too is like this website is called Stats for Startups, where it is basically a repository of formulas on different KPIs. Not all of them will apply in your business. Again, depending on the nature of business, some of these things really don't matter. But it is different ratios and KPIs and what people track and what are the main metrics that are important to different businesses down the line. And that is it from my slides. Davinia, I'll give you the opportunity or to like hop in and expound on anything I didn't touch on. But before you get to that, Lindira, if you had any specific questions on your business's nature and what are certain things that you probably need to track or keep in mind, feel free to let us know as well too, and we'll try to answer those questions as well.
Okay, thank you.
Yeah. Do you have anything now?
No, everything is just following and digesting what you have said so far.
Yeah.
Yes.
Cool. So yeah, Davinia, you could hop in on anything I missed on which might be important or what you want to hone in on. The floor is yours.
I had to switch rooms, so I didn't have any noise interruption.
Yeah, no worries.
You know, so you're talking about tools and this whole idea of what KPIs, et cetera, you present, again, whether it's to investors or to yourself, to judge your success. And one of the thoughts I had while you were talking, I just didn't want to interrupt you, is all of that stuff, like all of the connectors and stuff that you had, again, the way that I intuitively learned those connections is when you have enough templates, like for example, you have an Excel template, you literally just spend the time going through the formulas and clicking through. So if you're not an Excel geek like I am, then fine, that's not the way you're going to learn it. The next way that you learn it is in action. When you feel the pride of putting your first $100 revenue in your software, and then you look and you see everywhere that it populates, and then when you put in the expense and you look and see everywhere that it populates, every time you make your incremental adjustments to your financial statements, which technically should be daily, if not real time, but at least daily, you would intuitively begin to figure out how all of that is connected. So either you do it the textbook way or you do it live in action. Be intimate with your financials. Like that's a daily interaction. That's like any relationship. If you ain't talking every day, all day, or at least once a day, my goodness. If y'all ain't talking once a day, you can't tell me y'all in no relationship. That said, that said, with the financials for me, I think there are uh, so you mentioned Zoho, Lindira. Zoho is okay, it's cool. I think it has a lot of plugins, which is a great tool. A very, very simple one for someone who may say, look, I don't know all of this accounting stuff, I don't know all of this tech stuff. I find that Wave is probably the most simple that I've found. At first, I actually hated it because I thought it was too simplistic. And then I needed a quick and dirty one for a side thing that I was doing. And I was like, man, let me go try this one again. And it was ridiculous just how easy it was to use. And I really had to repent for not liking it at first because it's really dumb. It could have helped a lot of people if I just was more patient. QuickBooks is QuickBooks, if you full on and
She cut off for a second, but I mean, just to finish that thought, QuickBooks to me has always been that semi-corporate, whereas like
requires a bit more than the others, right?
yeah, exactly.
But again, you have to remember why. And I don't like the textbook angle. The why is what makes it worth your while. The reason why you need to know your financials is because you need to know your business. You need to know whether, if you had a forecast as a startup, one that you pull out your head, every day you need to know, okay, how close am I getting to that? Because each projection you made, you could break down to your daily projection. So when you take your daily projection and then you look at your daily results, that's how you know if you're on track or not. That's how you're able to stand in front of an investor and they could ask you off the cuff question and you could answer it because you knew when that particular metric began to tick up and why it ticked up. And you knew when it began to trash and go in the garbage and why it went in the garbage because you were watching the incremental changes. Your financial statements you will not be able to talk through if you do not watch on a daily basis. Now, part of the problem is a lot of us doing these forecasts and we never do nothing. So a forecast, again, I think as a pure startup, if you've never operated this business, you really need to just do either some common size forecast or some type of comparative forecast. So that those financial statements aren't real; they're inferences. However, if you have never done something in that business, but you've had other businesses, you're still able to talk through that forecast with people a lot better than someone who's starting completely from scratch. But the real magic in the financial statements is when you actually begin to, if not have revenue, but at least begin to have expenses. Because now you're watching the expenses and then you're watching the intangible metrics. Like, I may not have revenue yet, but do I have unpaid clients? Are my social media metrics ticking because my expenses on this side are ticking up? So these types of things, your financial statements, whether you're taking in a dollar or not, it helps you to be able to talk through a lot better with investors and yourself. Travis, I see Lindira has a question.
Yeah, that's awesome, Davinia. Yeah, so Lindira, you could hop away with your question.
No, it wasn't really a question, but I wanted to we'll make a statement based on what Davinia had said about QuickBooks.
Mm.
And I'll word it as a question. Do you suggest that I go and take further online training to actually get to know how to use QuickBooks, seeing that it's something that I would use? Just referring to what Travis had said on a mid corporate level, moving from startup, into that level.
Yeah, so let me ask you, if you don't mind, can I ask you a few questions about your business first?
Yeah, sure. Go ahead.
How many years have you been operational?
Well, this business idea is a startup, so I would say zero. This is some totally new idea.
Okay.
Yeah.
So for a totally new idea, I would recommend that you pay a professional to set it up for you. So they will populate your chart of accounts. They'll ask you questions about what you intend to do, and they'll set it all up for you. And in that experience, that's the first lesson, right? It's going to be a little bit more expensive than what happens when you pay for any QuickBooks Online classes, but it's one where you learn a lot more because you're learning the software whilst you're expressing yourself about your business. So that's step one. I think when you actually get to the point where you're booking expenses and booking revenue, et cetera, if you choose to do that yourself, which a lot of startups plan to do that themselves, then those extra tools come and help you when you try to remember, okay, what in the world did that person teach me when they set this all up? But it's a lot that it's very technical to set up your accounting system and then also try to manage it. Unless you plan on, selling accounting services on the side, I don't want you to spend
Mm.
so much time building your system when you really should be building your business. You have to look at every hour of your time has a cost. And what you could do in an hour, someone else could do in 10 minutes. So Let somebody set it up for you if it's not your thing, if it's not your background, and then you spend more time learning how to manage it rather than learning how to set it up.
That's a good suggestion.
Yeah, okay, great. I like that suggestion too.
Cool.
Yeah, I mean that was great, Davinia. If there, Lindia, if you don't have any other questions, or Davinia, if you don't have any other thoughts, we could wrap this up.
I do have some other thoughts.
Yeah, good.
So financial statements for me, again, like I said, is very personal. I remember, Lindira, the first day that I showed my daughter the first business that she would have been old enough for me to show her the financial statements to. And I think I didn't show her the incremental statements. This was at the end of the first year. And I printed it out. I didn't do it digitally. I printed it out and I gave it to her. And in true form, she went straight to the bottom, to the profit. Fortunately for that one, there was profit. um, and, I could remember her face. And there was a level of pride that, okay, my mom actually has a real business. Like, well, I had a real business all along. But the evidence of feeling and seeing the paper with the numbers on it, to at that time, I think she was probably 12 or 13. That was the evidence to her of, okay, this is a real business. And I'm telling you, folks, those who are here now and who will be listening later, seeing those numbers in action really makes you feel the joy of the business, that the joy of the hard work that you've put in. And so it's not the thing you want to slunk on. It's not the thing you want to procrastinate on, because it's the thing that could actually keep you motivated whilst you're going through the rough times of your business. So I try not to focus on financial statements for investors. I think those tend to be disconnected. I think if you connect your financial statements to you, your personal goals, your hard work, etc., those things make it much more meaningful. And you find that investors eat out of your hands because you actually know what the hell you're talking about. You didn't just study it 2 days before so you could figure out what to tell them when you go to meet in front of them. And that's what they smell. They sense when someone's coming in front of them who just read their statements for the first time, and trying to remember buzzwords from Travis, or whether it's something that they've been working with day in and day out, and they actually know what in the world they're talking about. That's the only thing I would admonish your audience, Travis, to do it for you, and then it makes it easier for everybody else.
It's so good, man. It's so good. To your point, okay, so Lindira had a question. She just dropped into the chat. Which part of the financial statements would you suggest monitoring every day, and what were usually key components they look for in pitching? So I guess it's like a two-part thing. So like, what do you monitor on every day, and what are key components for pitching?
Yeah. Let me tell you what I monitor every day. I definitely monitor the cash. I monitor the cash, I monitor the revenue, and then I monitor accounts receivable and accounts payable. With accounts payable, I want to know, I look at it in an age fashion. Are my payables getting any younger, or are they getting older? In other words, like, do I have people who I owe longer and longer and longer and longer? Or am I chipping away at that? Like, I want to see that come down. I want to see the day when the age is a 30-day age and not 2-year age, right? So I look at the age of my payables. Same thing with my receivables. Why these people owe me for 5 years, right? Or 5 months? Or like, is the age getting any younger? Am I able to turn over or to harness my revenue a lot faster than before? Those two things you want to look at on a regular basis if it's active revenue. If the business isn't as active, you have to watch your cash. Your cash, meaning, for me, when I say cash, I'm really talking about the bank. And it's because a lot of things happen in bank statements. It's looking with a company and they're just realizing years later that they had a significant increase in transfer fees, in bank fees, that was literally 20 to 30% of their bottom line. And if you're not watching that on a daily basis, you won't make the incremental changes.
Or just
So,
yeah.
or yeah, exactly, or to change your methodologies. So you really have to, I can't say like this part versus the next part, but if you watch the bank and you watch the receivables and payables, you get a good daily snapshot. I would say cash flow you probably watch more so on a monthly basis, because if you're watching the other things on a daily basis, it translates. So your second point was,
What are key components that they look for in people look for in pitching?
um, I'm sure Travis would have mentioned this in some of the other sessions, but people give money to people. So in the pitch, when it comes down to the numbers, I'm going to say this again. The biggest thing they're looking for is whether you know them, whether you're confident, whether you feel you could take those assets and convert the assets to revenue. I think that's the biggest thing that people look for. Outside of that, in terms of the binary, the looking at the actual zeros and ones of it all, they want to know whether this business can produce cash. If I give you this $100,000, are you going to run out of money tomorrow? So am I going to be wasting my money because your runway is a 2 year, $300,000 runway, but you telling me you could survive off 100,000 because you can make it work, you can make it stretch, or this
Yeah,
famous word that we don't know nothing about called bootstrapping.
yeah,
Like, yeah, no, you're gonna run out of money.
yeah,
Like, so many companies they start off with more money than they thought they needed, and they still run out of money. So the investors want to know, are they just throwing away their money because in 3 weeks you can be back to them asking for more money? Unless that's how you pitch it. If you pitch it as a rolling investment, then no problem. But if you thinking, hey, you could give me 100,000, and then I can give you back 200,000 in 2 years, you got to prove that,
right.
and it got to make sense.
Good man. Such raw wisdom. It's good. Yeah, really good, Davinia. I don't have any other thoughts on that, but you think you touched on like the 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 distilled points for both of those things, and it really comes down to who you're pitching to. Knowing who you're pitching to or who you're asking money from is also important as well too, to factor in with aligning with your goals and what you're capable of. I think to Davinia's point, um, and I think that's something that I'm gonna take more in focal point of me as well too, is that look at the numbers for you. How healthy are you in your business and your metrics? And I think if you do all the things right, when it comes time for those opportunities, you'll be in a good confident place. But even to the place where, and we tell and we said this before in previous talks as well too. One of the things that we like to get out of educating who we work with is that, yeah, raising money is cool, but we're also trying to teach you how to not raise funds if you could generate the funds yourself. And I think a part of knowing your financial statements gives you more of that empowerment to make the plays that you need to make without fully leaning on the investment money. But if it comes, you'll be in a good enough spot because you know your numbers and how to work them. So thank you again for that, Davinia. I'll take that to heart for sure. Like, do the numbers for you. Yeah.
Yeah, man.
Yeah.
I had some forecasts over the last year and a half, and if I haven't redone easily, no exaggeration, 50 times,
Yeah.
and I haven't done it at all, right? Like, it's a live document. If you ain't see your forecast in the last week, even if you're operational already, but definitely if you aren't operational, but you're researching and digging into things, then that document is live. And that's
Mhm.
why I do mine in live plan,
Mm.
because so you talked to I was supposed to mention that my biggest forecasting tool is still LivePlan. I know other people use different things, but I use LivePlan. LivePlan, you could bring in, you could import your QuickBooks actual numbers, and it will compare what you projected versus the actuals, and then you could adjust your projections as you go. Like it really should be a live document.
Mm. So let me ask you a curveball question. We could probably close up after that. What do you think? Because again, we all of this was talking about essentially learning to love your numbers, but there is an inherent fear or reluctancy for entrepreneurs looking at numbers. It's almost like they're scared of numbers. Even on a personal level, people are scared to like really dive in on those numbers. Why do you think that is within a startup context, and what are some ways that we could get more confident in terms of approaching our numbers or learning to love our numbers as we go along that process?
Yeah. Okay. So I'm gonna talk about two different type of numbers: post money and pre money. So post money numbers, just being a bit human and transparent here. You know, when I find that I'm a little scared to look at my numbers, when I
Mm.
know they going down.
Yeah, yeah, it's
Gosh,
yeah,
I don't see that today. Like,
yeah.
I know that ain't going right. Like, you don't want to face the music until you have a call with your accountant in a bit. So you got to look at that before you speak with your accountant because nobody wants to look stupid, right? So that's when I falter. That's when I fail. When I know the numbers already look bad, because I know I could feel what's happening in the business. And so I think that fear of failure is what sort of wants people not to see the numbers, because the numbers are the mirror. That's where you see what's really happening. The result, the other side of your effort, is reflected in the numbers. Pre-money, meaning pre-revenue. Um, so the fear there is that people just don't feel like they really know it. And that's why you shouldn't be going into it if you don't know it. A lot of people are gambling with these startups, man. We had one guy one day say, his business is the best because he's cooked the best.
Right,
Like, like then we have a whole Bahamas wide
right.
contest, and you could be the best chef, but you could be horrible at running a business.
Mm.
And that, yeah, cooking well, many mothers cook well. It doesn't mean that they make money and monetize that
Right.
well. So yeah, we're afraid of those numbers pre-money because we frankly just do not know it. And this is where, especially in the Bahamian context, which I know this shouldn't really be only in the Bahamian context, but I find that a lot of Bahamians are afraid to pay professionals to do what they do.
Mm.
If you're good at cooking and chefing it up, pay someone to help you with your numbers. Stop being cheap. I mean, the wealthiest of people spend loads of money on their accountants, their financial advisors, their lawyers. I mean, these are well-paid professionals, and they also know the things themselves. I could do financial statements, but I don't do my own accounting because, again, it comes down to the time value, the value of my time, the value of my time producing versus an hour of doing accounting. No, son, it's better for me to pay someone to do that. I can interpret what comes out of it. So get rid of the fear by getting help. That's what I would say to pre-money people.
No. Good stuff. Awesome, man. So yeah, with that, we can wrap up on that. I think that was awesome. Lindira, hopefully you got a lot of that as well too, as much as I did. Thank you, Davinia, for coming and dropping the knowledge as well too. And this
My
wraps up
pleasure.
the workshop number 4. So we have one more workshop in the series. After this, it will be in 2 weeks. If you want to find out more about that workshop and sign up for that as well too, you could go to our website at hourlink.com/funding. It'll take you to the landing page where you'll find out more details on the event, and then also stay tuned for more events that we'll have promoted coming up for the rest of the year as well too. But again, I'd like to say thank you for everybody for taking the time to watch this. Thank you for the knowledge, Davinia as well too, and hope you all have a solid night. Continue to do well, work on your numbers, don't shy away from it, and we'll see you next time in the next one. Thank you.
Thanks as well. Take care.
Thank you.
All
Bye-bye.
right.
All the best, Lindira.
Thanks.